Okay, now I'm going to share with you some trading techniques that this is what I really love. This is why I got into the business, and this is my favorite thing to share with you. Literally open your minds to some new techniques. I'm sure some of you have seen these techniques. This is based on market geometry. Now, while our trading systems use nonlinear predictive models, they're not what I'm going to show you. We've learned to program some things that are similar. But what is remarkable is that these old master techniques that you could literally do with a pen and a chart paper, or you could do it with your computer, offer very similar results to our highly accurate predictive model, which is running 60 to 80% accuracy for a system that's very good. Before we get into some of the techniques, I just want to give you the basics for what I use when I trade discretionally and when I make market projections. And part of it's based on Elliott Wave Theory. You'll find people that are adherents to the Elliott Wave principle, people that love it, people that do not understand it, people that can't use it very well. But I've created a group of methodologies that, when used together, give an objective approach to Elliott waves. But the basic tenets of Elliott Wave are it categorizes the markets into different waves so that you know where you are within a move if the market has a good looking wave structure. It doesn't always, but when it does, it gives you a very high degree, what I would consider a high degree of probability, better than any other single technique of categorizing the market. And you'll see some examples like in the euro, the pound, the Australian dollar, crude oil recently, even the stock market, that the wave structure unfolded perfectly like a textbook. The bottom line with the wave principle is this. It starts at the bottom, and the inception of the wave is a zero. The first wave up from that 0 point is wave 1. That's just short covering from the previous down wave. And then at the top of wave 2, top of wave 1 rather, there are people still looking to go short from the previous downtrend, and so there's a correction. It's often quite choppy, and it doesn't make a new low. That retracement's bottom wave 2. The next wave up is when you get the professionals and funds buying into the market, and that causes a dynamic up move, which is wave 3. Wave 3 will tend to be the longest out of the 5 waves. 1, 2, 3, 4, 5. It will have the steepest slope. It will have the most momentum, and will typically run 132% of wave 1 to as much as 400% of wave 1, 420% of wave 1. Then after wave 3 goes up, you'll have a fourth wave correction that will not take out the top of wave 1, and then finally you get the fifth wave up. And wave 5s tend to equal more or less wave 1. Important thing to look at this is just wave 3 tends to be the biggest. Wave 4 pulls back, and then there's one more high that has less momentum typically than wave 3, and that's very easy to notify with divergences and other indicators. And those are places to go short, in which our system recognizes automatically, and I'll show you some examples of trades here in a minute that our system picked out, and that will be picked out from the techniques I will. Okay, the next slide is a real market example of the Elliott wave progression. So this just gives you the foundation so we can quickly run through the slides in a lot of different markets. Here we have, let me run back to our last example. We had the wave 1, the wave 2, the wave 3, the wave 4, the wave 5. So now we have, here's an example, real life example, wave 1 up, wave 2 pullback, very choppy, wave 3 going up, has the steepest angle of ascent, the most momentum, it's quite a bit larger than wave 1, then wave 4 is a shallow pullback, and wave 5 a smaller move with less momentum, and then the market pulls back. A couple other little things that if you're not familiar with these little gems, is that when the market takes out the wave 2 top, or the wave 1 top, the market tends to gap, continuation gap, and that's because there's a lot of, that's a a lot of stops at the top of wave 1. In case the market does go above wave 1, people are going to buy and get these gaps. It's really fantastic. So when you do get those gaps, when it takes out a high, chances are you are experiencing a wave 3 run-up, and that market's likely to continue for some time. That's relative to the to the size of wave 1, actually higher, more momentum. Anyway, I want to move into the real juicy stuff here. Another thing with regard to Elliott Wave that you want to remember for the rest of your lives is after you get a fifth wave up, which is this 5, and it has lower momentum, and it typically has a lower slope, a lower angle of the slope, when the market does start selling off, it will retrace back to the low of wave 4. This is wave 4 right here. So watch this. Here's a wave 1 up, a wave 2 decline, a wave 3 up, a wave 4 decline, a wave 5 up, and then where should it go back to? The top of wave 3 or the bottom of wave 4. So the market, this is the top of wave 3, pulls back to the top of wave 4, and then finds support either at the top of wave 3 or the bottom of wave 4, and then it goes up to a bigger degree, wave 5. Where should it drop back to? The top of wave 3 or the bottom of wave 4, or possibly this wave 4 down in here. And you'll see this over and over and over again in real life and in the examples I'm going to show you. Okay, here's a chart. I'm showing you this just to give you an idea of the power of this analysis. Here's the New York Stock Exchange Composite Index. I actually published this in a newsletter on August 3rd, 2001. This was 5 weeks prior to 9/11. And literally I said that the New York Composite had fulfilled the requirements of an Elliott Wave supercycle top. Can it go higher? Of course. However, the next 2 years, a normal seasonal down move in September and October through November should be more pronounced. I was actually looking for a cycle low, and actually in my newsletter I put October 2002, which is exactly what happened. When the 4-year cycle was due to bottom, and it happened, I published something with institutional traders I was working with on the day before and the exact day of the low, and then after confirming the low, that the October 10th or 11th low was in fact the low. Now look at this last wave up. Let's start over here from 1990 or 92, whatever the low that is. We had a nice 5-wave movement up. 1, 2, 3, the biggest. Wave 4 that pulls back to the previous wave 4 in here. Watch this. 1, 2, 3, 4, 5. Should pull back to the wave 4 area. Nice support there at the wave 4. That's the 1987 crash. Then goes up again. 1, 2, 3, 4, 5. Now at this top, wave 3 is the biggest. We thought the minimum the market would do would pull back to the 1998 low, which it did, and then it pulled back to the I think the 97 low, somewhere in here, which is the wave 4 of lesser degree. So when you learn these techniques, and you'll notice that wave 3 was the biggest, wave 5 had less momentum, less of an angle, it was shorter, and there's usually some kind of pattern that can allow you to get short. And the bigger the move, the longer the longer it allows you to get time to get into the market. So there's plenty of time to look at this top, analyze from Elliott waves, from cycles, from many reasons to take advantage of that historic down move. And yet there's